Some preliminary work that I'm doing. As we get set up, we're trying to think deeply about DeFi. And what I mean by that is we want to understand kind of the economic trade-offs involved in participating in DeFi markets. Okay, we want to take a deep stand on why people provide liquidity, what gains they hope to get, and how the pricing curves, the ad hoc pricing curves we subject in DeFi markets impact that allocation of surplus. Okay, and so that's our goal. In some ways, it's related to Rob's talk, of trying to understand the economics of these new markets these technologies are providing. But we're going to try to do something much simpler, I think. So we're, like I said, trying to do something right now that's very simple and going back to first principles. And so this is work we're calling automated exchange economies. It's joint with Brian Rutledge, who's here, and one of our PhD students, Yikang Shen. It helps when thinking about DeFi, perhaps, to take a step back and think about intermediation more generally. Okay, so trading crypto today seems kind of both necessary and important for market participants. Why? I think there was an ideal. We could use it to spend for goods. It doesn't seem to happen all that often right now. But we are seeing a lot of participants trade crypto either to adjust the timing of their ownership of crypto, to adjust risk involved in their portfolios of crypto, swapping one token for another, and perhaps to speculate dealing with differences of opinion. And so I want to take a step back and think about intermediation generally. This is my simple way to explain it to our undergraduates here in blockchain classes at Tepper. I might think about two traders, Alice and Charlie, who own some different tokens and want to transact. And if they're in the same place at the same time, life is easy. They can just trade these tokens. But generally, people who want to trade might be separated across time. Rob described a double coincidence of wants inducing a Wixelian triangle. That's an analog of that, but here across time instead of at a point in time. And so how can Alice and Charlie trade? Well, almost all of intermediation is a character like Bob shows up and says, I'll play the middleman, trade with me instead. And so Alice and Charlie can send their tokens to Bob, and then Bob can ultimately do the swap on their behalf. Canonical intermediation. Now, roughly speaking, in the world today, we see two categories of quote unquote Bob. Okay, there's the traditional centralized model. Think exchanges like Binance, BitMEX, FTX. What happens with these exchanges? You send your stores of value to the exchange, and then you trade liabilities of the exchange. You engage with messages via the exchange and trust that exchange to operate and ultimately send you stores of value. Okay? Now, given you have sent all of your stores of value to the exchange, that creates a lot of risk because you are trusting that person to house your value. And if their name happens to be FTX, that risk may not have resolved in your favor. You might have lost your stores of value. So it's unsurprising people are looking for alternative solutions that don't require you to send stores of value to a trusted party. And these are the DeFi exchanges we are seeing, things like Uniswap and Curve. You trade via smart contracts. All trades happen on the blockchain ledger itself. Now, what are the challenges of doing DeFi? So it helps, again, to think about CeFi, quote unquote. The canonical model of exchange is via a central limit order book. If you want to trade, you might post an order. Either you want to buy or sell an asset, the number of assets you want to trade, the number of coins, and perhaps a price you want to trade at. And then there's some execution, price that determines a price priority that matches buys and sells, and perhaps some time priority. Here's Coinbase's. If I were fast enough with OBS, this would be live, and you'd see those numbers, bids and asks, blinking like crazy. And every time they blink, that's someone sending a message to the exchange. Please modify the state of your single quote unquote ledger on my behalf. That enormous volume of messages makes implementing this type of limit order book on a blockchain basically infeasible. Okay? Orders and trades here happen in DeFi on-chain. And because all of those messages have to happen on-chain, every time you modify a bid or an ask, you would be asking the state of the blockchain to be updated by the validators. There would be a transaction cost, and there would be some latency for most blockchains. And so that makes this impractical. So what happens instead? Instead, we get things, here's Curve. You post some swap rate, and there's some ad hoc pricing curve that tells you how you're going to transact. This is big business today. This isn't peanuts, okay? $1 or $2 billion a day are going through these exchanges every day. And so we think it's worth investigating how this market works. What do? They embed some pricing function in a smart contract. And the idea is liquidity providers, the Bobs in this market, are going to send bundles of tokens, portfolios, to a smart contract. The portfolio in the smart contract determines the relative prices liquidity takers ultimately will face. They can buy and sell some token QB in exchange for QA tokens according to this function embedded in the smart contract. And so again, we want to understand, how does this function G facilitate gains to trade between liquidity providers and liquidity takers? Okay, so we're not thinking about arbitrage limits off exchange and on exchange. We're going back to first principles to understand how exchange happens in this marketplace between liquidity providers and liquidity takers. We're going to develop a simple, tractable framework to analyze these questions. One thing I'll try to emphasize to you today is, new technology, new markets, same old frictions. Okay? In a canonical limit order book, intermediaries are worried about adverse selection. If someone wants to sell me the asset, they must know it's bad, and I have to affect my price to account for that. In a DeFi market, you can't change your price. The price is specified by the contract. What you can do is distort your quantity of allocations you provide to the smart contract. So I'll show you how adverse selection distorts intermediation quantities rather than prices. So a toy environment, and I'll try to get to our results. For the economists in the room, we're going back. We're putting Edgeworth boxes to understand smart contract DeFi markets. Okay, so it's going to be a 2-agent, 2-asset economy. Again, today it's static. We're developing dynamic versions of this going forward. I'm going to have 2 risk-neutral agents, a liquidity provider, and this is the agent we're most interested in. They own some endowment, let's call it capital EA and EB, of a pair of tokens A and B. If you like, Ethereum and USDC. It's not a big deal what the tokens are called. Then there's a liquidity taker who can trade using this AMM, and like canonical intermediation markets, we'll think this liquidity taker could either be informed or uninformed. And I'll show you exactly how we think of informed and uninformed trading in this model in a minute. We'll assume each token yields some value. I'm implicitly not using the word quote unquote price here. I'm trying not to. We're thinking of this as your true valuation of the token. I don't want you to think of that as a Coinbase price per se. It's your own perspective on what this token is worth. And since it's a static model, the service flow and the terminal value are the same. I'll let mu denote the average valuation of this token I. Okay? So what's the sense in which we have a liquidity provider and a taker? So we're going to assume the liquidity provider moves first and deposits some portion, little EA and EB, of their endowments with the smart contract. The liquidity provider's choice is to decide how much they want to contribute to intermediation quantities. They're a provider in the sense that both of their deposits, quote unquote, are positive. They're neither buying nor selling. They're depositing both of their tokens. Now, in all models of intermediation, you have to take a stand on why is the intermediary the intermediary. And our assumption here is the liquidity provider is sort of naive or quote unquote slow on the blockchain. They are aware they can't get priority on the blockchain. They know they're not a high frequency trader who can arbitrage prices perfectly, but maybe they can earn some profits by providing some intermediation value. In contrast to them is the liquidity taker. They get to choose some quantities QA and QB according to the pricing rule. Again, they're a taker in the sense that you should think one of the quantities is positive and one negative. They're buying one token from the other or selling one token to the smart contract. And that's how they're using the liquidity provider's balance sheet, if you will, to intermediate. For today's talk, we're just exploring the kind of common use constant product rule, which says the ex post allocation for the liquidity provider, E plus Q multiplied, has to be the same as the ex ante deposits they provide. Okay. After deposit and trade of a liquidity taker, all shocks and payoffs are realized. So there are gains to trade in this model because we're going to make an assumption that the liquidity taker realizes a shock to their beliefs about the value of these assets. I have 2 agents with potentially heterogeneous beliefs. They can create gains to trade by facilitating trade between them. Now we're going to have 2 types of these shocks. In one, we'll think of as the classical quote unquote uninformed liquidity trader. Think of this as a shock to their belief of the average value of the tokens. We'll interpret it as a taste shock. This is orthogonal to the liquidity provider's beliefs about the value of these tokens. For whatever reason, this person thinks Ethereum is going to go way up in value. That hasn't changed my beliefs. Now there are gains to trade between us. Okay? On the other hand, it could be that this trader is informed. They realize a shock, Ethereum is going to go way up in value, but this shock is correlated with our liquidity provider's beliefs. What's the problem? The liquidity provider's slow and they can't withdraw their tokens quickly. They're aware of this when they make a decision whether to deposit or not. And we'll let pi be the probability this liquidity trader has these taste shocks. They're an uninformed preference shock trader. So we solve this model, unsurprisingly, by backward induction. You're a liquidity taker, you're risk neutral in this model, but you face convex prices from that ad hoc pricing curve. So of course, you're not going to go to some extreme boundaries. You're going to trade until your relative valuation of the tokens is equated with the relative price implicit in the contract. That equation shows you the ex post relative beliefs of the liquidity taker should be equal to the ex post quantities here. And so that implies if you're the liquidity provider, you know this taker is going to realize these shocks and push you to some point on the pricing curve. XA and XB is your ex post portfolio. The pricing curve is a function of your deposits EA and EB, and then it's going to satisfy this relative valuation of these tokens. I think perhaps a picture makes a little more sense. If you've seen Uniswap or Curve, you've seen this picture a million times. I have quantities of tokens on the X and Y axis. We have a nice convex pricing curve that says all allocations of the liquidity provider end up on this point. You're a liquidity taker, you realize a shock to your valuation. That dashed red line defines all the points that give you the same utility from these pairs of tokens A and B. The slope reflects your relative value under your shocked beliefs, mu hat A and B. You're going to trade until the slope of that indifference curve, that line, is tangent or equal to the slope of the pricing curve. Very simple. Again, if you're in an Edgeworth box world, there's an upper right corner I'm not showing you here. The liquidity taker's in that corner and they're moving down along this curve. That picks the ex post allocation for our liquidity provider, and she knows this. Is this good or bad news for you? It's not obvious. I haven't told you the liquidity provider's preferences yet. So what does our liquidity provider do taking this as given? They're going to maximize their expected utility. And what is this equation? The first term says with probability pi, I'm going to be facing a noise trader, an uninformed trader. They're going to trade to some point, but they haven't changed my valuation of these assets. Mu and A and mu B haven't changed. They're my prior valuation of the assets. And then I compare the relative portfolios I get, XA and XB, as a function of the shocks of the noise trader against how much I deposited up front. And the second term on the right, the 1 minus pi term, is the probability I'm facing an informed trader. But now my beliefs are correlated with theirs. They're distorting my portfolio, but I understand their beliefs are now the same as mine. They're an informed trader. What is my choice? Again, it's to choose what fraction of my endowments EA and EB to deposit. And by doing that, you can see in the first equation on the second line, I'm changing the pricing function and where I'll end up, changing the position and slope of that pricing function with my choice of deposits. So how do we solve this? It turns out you can rewrite this equation. It looks messy, but don't look too hard at the math. First, look at the far right term. There's a negative in front of that term, and it says you're going to suffer a loss by choosing quantities of tokens that are different in your average valuation. I'm staring at some of my co-authors who work in these markets a lot, and they're saying, no. You're a liquidity provider. You always deposit on Uniswap or Curve in equal values. And indeed, our model has this flavor. It says you want to deposit in equal values. To the extent you deviate from that, you suffer a loss. But look at the first term now. The first term has two components. One depends on pi, the chance you're trading with uninformed traders. That term depends on the effects, the realized, or the average of the realized differences in beliefs. That reflects your gains to trade with uninformed traders, and that's positive. You enjoy rents from trading with these uninformed traders. What are the costs of that? There's some chance you're facing an informed trader, and it turns out in those states you always lose. So as in all canonical intermediation models, you're going to make some money on the noise or uninformed traders and lose some money on the informed traders, and how you balance that will distort the kinds of liquidity you want to provide. Maybe just an illustration of the uninformed trade because a graph is helpful. Here, again, I have our pricing curve in orange. Imagine the liquidity provider provides EA and EB, the point at the top left. And for some reason, they get distorted to the bottom right allocation, the black point at the bottom right. Well, to the extent my beliefs as a liquidity provider haven't changed, this is good news for me. Why? Because this noise trader is trading along the curve at prices I don't find favorable, which means they're giving me profits. Those are the profits I gain. You notice there's a small region where they could trade below my solid blue indifference curve that makes me worse off. If I were only facing uninformed trade, I would find this profitable even though there's a chance I lose some profit. That is the sense in which I'm not providing deposits in equal value. Why? Because I get larger gains on the very noisy, uninformed trades. I have a second order loss from deviating from equal value deposits and a first order gain on large trades like I'm showing you here. Conversely, if I end up at the same point, but it's an informed trader, I'm really upset. Why? Because now this is the case where I think mu A has fallen a lot. I think token A, Ethereum, is worth very little. But this liquidity taker is trading down along the pricing curve at very favorable prices given my beliefs. I'm just turning over value to this liquidity taker. That's costly for me. I have to balance these results. So we get a theorem that characterizes optimal liquidity provision. You can solve for the optimum. It's very tractable. But what do we learn from this? So first, you might ask, how does informed trading distort liquidity provision? What do we show? As the amount of uninformed trade falls, you're more and more dealing with informed traders, you converge to providing equal value deposits. Why? Because you're worried about just losing out and having your value arbitraged away by this fast informed trader. This speaks to the canonical wisdom we hear in these markets, and it's explicitly the sense in which adverse selection distorts gains to trade in this market. A last result for today, what happens as the risk in these tokens goes up? So we consider token A a stable coin like USDC, token B a risky coin, say like Ethereum, and we show as risk goes up, this was surprising to us, liquidity provision becomes more profitable. Formally, what I mean is if the beliefs of the liquidity taker become more dispersed, holding everything else fixed, my profits from providing liquidity go up. The gains on the uninformed traders rise relative to the losses on the informed trade, which is not obvious to us. A graph shows you this in a sense. I'm showing you what fraction of uninformed trade do I have to believe is out there for me to deposit liquidity on this DeFi exchange. And as there's more and more heterogeneity of our traders, our liquidity takers, the fraction of uninformed trade that are profitable for me falls. So in fact, intermediation becomes more attractive. Providing liquidity in DeFi markets becomes more attractive as I think there's more and more risk out in the value of these tokens. So we found that a little bit surprising. Let me wrap up. We're exploring the consequences of this constant product market-making curve for the allocation and gains to trade in DeFi markets. In progress, we're extending the analysis to a dynamic framework, which will allow us to connect the model gains to trade to empirics from existing AMMs. Specifically, the model has stark predictions for how liquidity deposits should vary in response to trades, much like the conventional market microstructure has studied how prices should respond to trades at the bid and ask. So we're performing analogs of those. And then more long run, given the tractability of our framework, we're starting to conduct some robust mechanism design. So if there's a lot of uncertainty about the nature or the distribution of possible valuations in this market, what does our framework tell us for how we should design pricing curves to exploit gains to trade? All right, thank you. I'm holding us from a break, so I'm happy to take a question if there is one. Otherwise, we can move for coffee. Go ahead, bro.
When you used the word optimize, but I'm not quite sure whether you meant maximizing from the point of view of strategy of one or the other, the sense of overall constrained optimal trade-off, blah, blah.
So we meant it very much in the sense of the privately optimal allocation is to choose this. In terms of efficiency, again, given this ad hoc pricing curve, we can study to what extent does this actually socially optimize gains to trade.
And so where does the ad hoc curve come from?
It came from a blog post written by Vitalik Buterin. I mean, that's in jest, but it's also true. Buterin said this is how you should design a decentralized exchange, and people like who designed Uniswap developed it and ran with it. It's not unsensible in the sense of it ensures all trades are feasible because the marginal price goes to infinity at either extreme. There's a question, and some people in this room have done a lot of work understanding what other incentives arise when you design a decentralized market in this fashion. And so we're abstracting from a lot of those issues to just go back to the first principles, but there are a lot of interesting questions here.
It's like Captain Shouldn't.
Yeah, absolutely. All right, thanks everyone. We'll take a break. I'll just add, so we break until, do you have a time?